You ever looked at the money in your bank account and thought, y'all just sitting there not making money, huh? Your checking account isn't doing anything, and your traditional savings account probably isn't doing much either. Meanwhile, the bank is probably making money with your money. I am not a financial advisor, and this is just practical guidance. Viewer discretion is advised. Welcome back to CWM University, where we learn together. And today we're going to learn about certificates of deposit, also known as CDs. We'll cover the pros, the cons, one strategy called CD laddering. I'm also going to help you find information where you can open up an account to get a CD. And we're going to plug in some numbers on a CD calculator to see what type of interest you could possibly make. What exactly is a CD, you may ask? A CD, also known as a certificate of deposit, is basically like making a deal with the bank. The bank says, leave your money with us for 6 months, 1 year, 3 years, 5 years, and then we'll pay you a guaranteed interest rate on your money. So you like, cool. That's basically it. Your money goes in the bank, time passes, you earn interest, and then you decide what you want to do with that money once your CD matures. No stock market drama. You don't have to open up your app and check and see if you've lost money because the stock market is going down. But here's the catch with CDs. Your money has to stay in that account until your CD matures. So if you agree to let the bank hold your money for a year, you have to let that money sit in the account for 1 year without touching it. If you decide you want that money before that 1 year that you agreed to, the bank's probably going to take some of your interest you earned on that CD. Before we get into all of the pros about CDs, let me make sure that I am clear about this. A CD is not like an investment like buying stock or an ETF or a mutual fund. It's really more of a savings tool. You're trading flexibility for a guaranteed return. Think of it this way: a checking account is for spending, a savings account is for easy access, and a CD is for money you know you won't need for a while. So let's get into the pros. Pro number one, guaranteed returns. I like to think of CDs as the Hondas of personal finance. They're not flashy, they're not exciting. Nobody's bragging at the barbecue about a CD that they opened last week. And much like Hondas, they are dependable. But not too much on Hondas, not too much. I had one for years and didn't have any major issues with it. And shoot, I wish I still had that Honda. But Hondas are just like CDs. They're reliable, they're predictable, and you know exactly what you're getting before you even deposit your money. Pro number two, FDIC insured. Most CDs are insured by the FDIC up to $250,000. So if the bank somehow goes out of business, your money is still protected within those limits. Now, if you compare that to the stock market, nobody can promise you that your portfolio will be worth the same thing it was yesterday and then the same thing tomorrow. But you can for a CD. Pro number three, which is probably my favorite, the higher interest rates. This is where the CDs get to shine. Your checking account will probably give you like 0.01%. Your traditional savings, it might get up to like 0.04%. Your high yields, we're looking at 4%. But CDs right now, they're going between 4% to 5% for your fixed interest rate. That may not seem like a big difference, but when you start talking $5,000, $10,000, $20,000, that interest rate, it matters, especially when you're trying to grow your money. And with those high interest rates, you're getting rewarded just for letting your money sit in that account for that guaranteed amount of time. Now, let's talk about the downsides of CDs. Like anything that you put your money in, it's not going to be perfect. So, if you guarantee that you're going to, let's say, get a CD for 6 months, your money is basically locked up for the next 6 months. So, the bank's like, yeah, I'll see you in 6 months. Because if you take that money out, here's another con: you can get an early penalty withdrawal fee. And I'm trying to make money, not lose money. And then our last con would be inflation. Some people don't consider inflation. So right now, if inflation is around 4% and you open a CD that's around 3%, even though your money is growing in that CD, by the time it gets out, it hasn't caught up or stayed the same as inflation. So your money is not worth as much as it was. Trust me, inflation is slowly getting us all. Mm. So you want to make sure that you are looking at what the inflation amount is percentage wise, and then compare it to what CD that you want to choose. Me personally, I'm going to look up the top earning CDs, and I want to get the highest one that I qualify for and that I will agree to the terms. Who's going to give me the highest fixed rate that I could get? You may ask, why would somebody put their money in an account for an agreed amount of time and can't take it out? Well, there's one way that you could possibly fix that problem. They call it CD laddering. Basically, this is how it goes. Say I had $20,000 that I didn't want to touch for the next, let's say, 5 years. I could, one, put this $20,000 in one CD for the next 5 years and let it sit there at an interest rate, let's say 4%, and let it go. However, what happens if something comes up in that 5 years and I need that money? But now it's locked in that CD. But I really want to use CDs because I like the safety that they have. So instead of putting $20,000 in one CD, I can take that $20,000 and break it up into four CDs, $5,000 each. So I can put one $5,000 in a CD for 1 year, and then I can put another five in a CD for 2 years, another five for 3 years, another five for 4 years, and that'll be my $20,000. So what's going to happen is that first CD that is for $5,000 for that 1 year. Once it matures, I can decide: do I want to keep the money because I need to use it for something, or do I want to reinvest it? And then I can reinvest it if I want to, put it up for the highest interest rate that I could find in CDs, and then I can wait another year. And then maybe in another year, another 5,000 comes available. Do I need it? So every year I'll have $5,000 coming available to see if I need the money, or do I want to reinvest it in the next highest CD that I see out there, because the rates that they offer for CDs do change. So in the next year, I could just look up the next one that's going to be the highest interest rate. So I'll have money coming available every year, but I'm still taking advantage of those interest rates for those other CDs that I have still cooking in the oven. Now I'm going to show you how to find the best CDs to invest in. So we're going to go through that and kind of talk about what's offered and what you need to look for when looking for a CD. So get on Google and type in best CD rates for today, and then we're going to click on the one that's under Bankrate. Pay attention to the interest rate and the term, and then see if they have a minimum deposit. So those are the things you want to look for when you're looking for CD rates. Now, depending on when you look up for these CD rates, these may not be the current rates. This is for June 2026. CD rates do fluctuate through the year as you go on. But if you keep scrolling down the page, you can just read through them and just see what they're offering. And then, of course, you want to read the terms and conditions to make sure that you can agree with those terms and keep that money in that account for that amount of time. Now, let's change gears and go to Bankrate and look at their CD calculator. So there is a calculator where you could calculate how much money you could potentially earn if you know what the interest rate is, if you know how long you're going to leave it in that CD, and if you know the amount of money you're going to deposit. The first one, we're going to say we're going to deposit $5,000, and our APY is going to be 14.10%, and we're going to keep it in there for 6 months, and we're going to see what it would do. So, according to this graph, our interest that we'll earn will be of $101.47. So, in 6 months, we're going to earn $101.47 for just letting our money sit there. So then we'll have a total of $5,101.47. Now, if I change that 5,000 to 10,000, and we keep the same APY, the same time invested, I will earn $202.94. And in total, I'll have at the end of that 6 months, $10,202.94. You're not going to retire on this money, but if your money is just sitting in a checking account, I promise you, you're not going to earn that much money just for your money sitting there in that account. We're going to go back to $5,000. Our APY is going to drop down to 4%, but we're going to keep it invested for 1 year. And if we do that, we're going to earn $200. So just for leaving our money alone in an account for 1 year, that $5,000, we're going to end up having at the end of that 1 year, $5,200. And then if we change it to $10,000, that money will double what we earn well, actually earning interest $400. And then at the end of that 1 year, we'll have $10,400. And so this is when things start getting interesting. You're earning a little bit more money for leaving in there for a little bit longer time. For our last example, we're going to still look at 5,000 and 10,000, but we're going to change the APY to 4.5%. For $5,000 at 4.5 APY for 3 years, we will earn $705.83. That's good money for 3 years because time's gonna pass by anyway. Like we're not stopping time. Nobody controls time on this earth. So if you have the money to do it, do it. Let it sit in that account. It's okay. If I don't need $5,000 no time soon, because I already have my high yield savings account over here building up and I don't need the money, then I can have 3 years to let it sit there. So then I will end up at the end of those 3 years having $5,705.83. Now we do the same thing with 10,000 at 4.5 APY for 3 years. We'll earn $1,411.66. And at the end of that 3 years, we'll have $11,411.66. Now we're talking some good gains by just letting your money sit in an account. So what would you do with all that extra interest that you're earning over those years? Would you reinvest it or would you spend it? Let me know in the comments. Who exactly is CDs good for? Maybe if you're saving up for a house, you already have 20,000 and you just wanted to sit in an account until you get ready to purchase the house and you want the money to grow. CDs could be good for you. Maybe if you're saving up for a wedding or you just have some money that you don't need for a while and you don't want to sit it in your traditional savings making no money, so you want to put it in a CD. Also, if you're someone who doesn't really do well with the risk and you don't want to invest in stocks or ETFs or mutual funds, then a CD will be good for you. Now, if you are watching this video and you're interested in learning about ETFs and mutual funds, you can check out my video right here when I explain the difference between an ETF and a mutual fund. But if you're not into stock market and you don't want to see the ups and downs and you want everything to stay flat, like I know I'm getting 4%, then the CD is definitely for you. If you think you're going to need it in 6 months, don't put it up for a year. Put it in there for the amount of time that you know that you'll feel comfortable with. Maybe just start off small. I'm going to start with 6 months, see how this process goes. And then if I feel more comfortable, then maybe next time I'll do a year. But if you don't like your money locked up where you can't access it or get a penalty for withdrawing it, maybe look into a high yield savings account. In this video here, I talk about high yield savings account and how they can work in your advantage while you're trying to save your money. At the end of the day, are CDs exciting? Nah. But not every financial decision you make needs to be exciting. Sometimes boring is exactly what you want and what you need. And you know you've become an adult when you're looking up certificates of deposits and seeing how they can work in your advantage. Welcome to adulthood. If this video helped you understand certificates of deposits, also known as CDs, give it a like and share with somebody else that it could help. And if you're not subscribed to my channel, make sure you press the subscribe button. And seriously, if I handed you $20,000 today, would you put it in a CD? Would you invest it? Would you put it in a high yield savings account? Or would you splurge? Let me know in the comments what you would do with that $20,000. Thank you for taking your time to watch this video. And you already know. Until next time, peace out.